It's a real pleasure to be here with the IDC family today. Thank you all for attending, and I really think this next hour will be of real high intensity and value for you. I'd also like to pause and just say thank you so much for your partnership last year in 2021 and the first quarter numbers that you've already provided into partnership already for this year. I'll be monitoring the chat function for our hour here with you and also moderating some of the Q&A, and I will try to bring some of the more poignant questions forward to the speakers during their sessions so that we're not perhaps waiting all the way through, but I'll watch for the right moments. So please, if you have questions, please populate them in the chat box so that I can see them and certainly bring them forward in the session. I'm looking forward to showcasing our industry-leading large case offering and the specialists behind that with the help of some of our Canada Life experts today. No stranger to Canada Life or the industry. First, we will be welcoming Brigitte Luce, Chief Underwriter at Canada Life. Brigitte, of course, has a long history with those of us with Pelican backgrounds, and she's certainly someone that's been welcomed with open arms back to our company just recently to take on the Chief Underwriter role. Brigitte will be joined by Sylvie Schmaus, our AVP, Large Case Underwriting, who will walk us through the practical case studies that you can use to implement into your business practices today. With this large case focus, it's critical that Sylvie will hand this over to Ryan Marcy, our VP of Large Case, who will walk you briefly through our commitments made and commitments kept on our participating account in 2021. You were aware from last year's presentations in many publications about some of the really interesting mixes and changes that Ryan was overseeing. And the fact that we've already got most of them completed or underway is really going to turn some heads in terms of our PAR account performance. Lastly, Ryan will hand over the podium to Chuck Shu, who is a regional sales director, one of our many powerful RSDs across the country. But Chuck will walk you through and discuss a bit of our competitive analysis and perhaps why illustrations don't always tell the whole story. We've got a jam-packed agenda and lots of worthy material to get through, so let's get started. Brigitte, over to you.
So today I'll be talking to you about why you should choose Canada Life for your ultra-high net worth clients and secrets to success in the large case market. So I wanted to talk to you a little bit about the large case underwriting and that it requires an enormous amount of information gathering. If not done well, this process can be long and drawn out for you and off-putting for the client. At Canada Life, we facilitate information gathering to smooth the process for both advisors and clients by providing exceptional large case support. There are a few areas I'd like to highlight for you today. We have vendor services, which offers executive facilities, and they're available for your large case clients. Dynacare Insurance Solutions and Exam One Canada offer executive clinic arrangements in large centers. This service is available for cases with annual premiums of $25,000 or face amounts of $10 million or more. The executive clinics generally offer the full range of services required with focus on the comfort for the client. How to obtain the executive clinic appointments are that when you're placing the order with one of these service providers, you ensure you indicate that it is a large case and qualifies for the executive facility. Arrangements will be made with the closest available facility to your client's workplace or residence according to their preference. We also have the paramedical platinum service for large case or high net worth clients. And this allows access to industry-leading level of paramedical services through Dynacare Insurance Solutions Platinum Paramedical Services. All applications with annual premium of $100,000 or more will qualify. Dynacare Insurance Solutions has screened and trained a handpicked group of mobile health professionals. This elite group of experienced client service-oriented individuals will ensure that they can arrive early and take their time servicing the client appointment and will help make clients feel at ease when they enter their home or business. And you can access this service by calling a 1-800 number, which we can provide to you, or emailing the VIP team at Dynacare when ordering the paramedical service. This service can be requested directly through Dynacare, as this cannot be ordered by head office. You will be asked to confirm the face amount and premium for application when you place your order. It's important to note that costs covered by Canada Life only include services that produce medical evidence. They do not include the cost of clients' transportation, meals, or other related changes. And you also have access to top-notch field underwriting experts to help like Dr. Bruce Empringham, who can provide pre-underwriting, active case, and post-underwriting support. He'll help identify additional details and information that can be included with the application to help the underwriter make the best medical assessment possible. You can contact him directly or through your wholesaler. You also have direct access to the underwriting experts who will have a hand in your actual cases throughout the process. We want to help you reach your optimal outcome on every one of your cases and keep you updated throughout the process. We are here to partner with you. The advanced underwriting expertise includes Stephanie Carter and Sylvie Schmaus, who are responsible for training and developing the advanced underwriting consultants and our large case underwriters, and for helping our teams obtain the best outcomes on all our large and jumbo cases. They are accessible to you and our Canada Life field partners anytime. And not only does our underwriting team of experts bring exceptional value to your cases, we also have our financial underwriting and accounting team. These are 4 individuals led by Liddell Barr. The team is comprised of individuals with backgrounds and expertise in business, finance, accounting, audit, and tax. They support training and financial underwriting guidelines to ensure consistency and ensure that we are meeting the industry changing needs and demands. And they can provide preliminary financial underwriting review and discussion, and they'll collaborate directly with the advisors and third-party accountants. They will case package the case for our reinsurance partners. They'll provide a financial summary, justification for the amount of coverage. They'll also provide field support. So if you'd like them to present or provide training, they can also provide financial underwriting tool, the Life Insurance Financial Underwriting Accelerator. And this allows you to calculate your client's future tax projections, income replacement coverage amount, other life insurance needs according to our financial underwriting guidelines. And it can replace other financial evidence up to $10 million of coverage. And they're also available for taxation questions as well. So a little bit about the secrets to the success. One of them is our preliminary underwriting review and discussion. If you have unusual setups or clients with any privacy concerns, medical histories of concern, or personal history and avocation, also travel and non-residents, and Google searches. It's often helpful to do a Google search of the client to make sure of any information that might be available on the public domain that may need explanation. And our underwriters will help package a case for our reinsurance partners. They provide full review of the case, provide a summary for the reinsurer as to how we saw the risk, and include Canada Life's evaluation and rationale. And they'll provide you with continuous updates, communication as our partners. So one of the other things that is important to consider is providing a one lead insurer. Capacity is finite and is compromised if more than one direct carrier is approaching reinsurance at the same time. Canada Life is operating based on a pre-COVID underwriting message with respect to capacity, so there are no concerns in that respect. It's important to designate a lead carrier and to instruct all other carriers to quote based solely on their own internal capacity. The lead carrier should order all the medical evidence, including any doctor's reports, and share all evidence with other carriers, which we call a med share. And it's best to complete the part 1 of the application for all carriers, so that if we are sharing paramedicals, that it's available to those other carriers. And that lead carrier should approach the reinsurance market if needed. And now I'll pass it over to Sylvie, who will talk to you about some case studies.
Thank you so much, Brigitte, for that great introduction and talk about the underwriting teams and really the power behind our teams. And I'm here today to show you or talk to you about a few case studies to really demonstrate the work that the underwriters have been doing for the past couple of months. So this first case is 100 million was applied for. The annual premium was 2.5 million on a 32-year-old male. Canada Life had assessed at standard rates, but we were receiving decisions back from the reinsurers, and all were with a medical rating of 150% to 200%. This young male did have some medical history, but Canada Life felt comfortable considering it at standard. So in this case, what the underwriter did was she did a phenomenal job of contacting all the reinsurers and really positioning Canada Life's decision and explaining our rationale, and managed to secure enough capacity to issue the full amount at standard rates once we blended all the offers and applied Astra which is our rating reduction program. So that was a great example of the work that our advanced underwriting team has been doing. So the next case was one of the larger cases that we did late last year for 150 million. This amount was being placed on a 27-year-old male. The advisor in this case had sent out the application to multiple carriers at the same time without making it clear to each company who was going to be the lead. As you can imagine, this caused multiple problems. First, we had a frustrated client and a frustrated family doctor. Each of the direct carriers ordered their own medical evidence. This meant that the client had the paramedical and labs completed multiple times, a huge inconvenience for the client. The family doctor also was receiving multiple requests from different sources for the APS to be completed. So the physician was really not happy and voiced his frustration to the client. So it was really not a good situation. Secondly, because each carrier approached the reinsurers concurrently, capacity was blocked, and none of the direct carriers had a clear idea of how much capacity was actually available in the marketplace. Also, as a result of this, the reinsurers were getting different information from each of the direct carriers. This resulted in a poorly packaged case, and although Canada Life felt that this case was standard, we were seeing some less favorable decisions from our reinsurers. Submitting the case this way did extend underwriting by months. After some discussion, the advisor ultimately chose Canada Life to be the lead, given all of our tools of the trade, which Brigitte reviewed earlier in the presentation. We had to work with the advisor to have capacity released from the other direct carriers so that all was available to us to make a final assessment and decision. Ultimately, we were able to make a standard decision for the full amount of coverage, and the policy was placed with Canada Life. So that's another great case. This next case involves 4 siblings, each of whom had significant coverage already in force, 75 million each. They were looking each to get an additional 25 million. Given the total line on each of the brothers, we could not auto-bind our reinsurers to these risks. We had to send copies of our application evidence to our reinsurers to obtain their support and participation. The advisor was concerned about 2 things. First, the cases needed to be underwritten, issued, and placed in a short time frame. And second, they wanted to limit the amount of financial information being collected from the client. The advisor worked with our underwriter and our accounting and financial underwriting team to determine which financial requirements would best suit this case. We ended up agreeing on a letter from the client's accountant who prepared the family's financial statements and tax returns, and this letter confirmed the net worth of each of the brothers. After the letter was received, we conducted a follow-up call with the client's accountant and our financial underwriting and accounting team, and we went over what had been received and addressed a few outstanding questions that we had. After that, what our teams did was they took the information and provided a summary and a memo for our reinsurers. And by working together on these cases, we were able to meet the target deadline, and these cases were placed and issued within 22 calendar days, which is really impressive for cases of the size, and disruption to the client was really minimized. So this was another great case study. Next up, I wanted to give you a quick example of the power of pre-underwriting and how it affects the outcome and experience in large case underwriting. In this case, the client was 52 and was looking for about 15 million of par coverage, and the annual premium was $1 million, including the ADO. This client had significant wealth in Canada, also had some in-force coverage with other carriers. When we discussed the case with the advisor in pre-underwriting, we found out that when the client had recently divorced from her spouse, She kept all the Canadian assets in her name, and her spouse had received all the foreign assets. We helped the advisor draft the cover letter for this case, and also provided the advisor with a detailed list of options that the client, suggesting different types of supporting financial information that underwriting could consider to justify the case. So the client opted to provide copies of property value assessments and mortgage statements because she owned a number of homes in Canada. In addition, we obtained account statements to verify her Canadian liquid assets. As a result of all the work that we did in pre-underwriting, this enabled the advisor to package the case as discussed, and we were able to issue this $1 million premium case in 15 days. Again, that's super impressive for a case of this size. Just know that Canada Life's underwriting team is here to help you both before and during the underwriting process. For my final case study, I have a really great example and really exciting one. I loved working on this one. Applications were submitted to 2 other carriers on these individuals, and they were looking to place $95 million total between joint lasted eye coverage and single life. The total amount of premium on this case was $2 million. The advisor did a great job of indicating in this case that Canada Life was taking the lead to underwrite the case, to work with reinsurance and obtain medical evidence. But applications were submitted to multiple carriers at the same time. This couple was new to Canada, here for 2 years, and were assessed under our affluent New Canadian guidelines. Financial evidence was submitted for both their Canadian assets and foreign assets. Our accounting and financial underwriting team, their review took only 3 days, which is absolutely outstanding given that we were provided with over 45 different supporting documents with well over 500 pages of information to go through. The team carefully organized and packaged the information prior to submitting the financial package to reinsurance and provided an additional explanatory memo. Due to the complexity of the case and of the financials, and the sheer amount of information to analyze, it did take 2 full weeks for the reinsurers to provide their financial assessments. During this time, Canada Life's underwriter and accounting team participated in numerous calls with our reinsurance partners to walk them through our assessment. All this additional work paid off when we secured approvals from all of our reinsurers, and they agreed to support us for the total amount being applied for.
I wonder if you could just circle back just for a moment, because I think you might have understated the value of that packaging. I don't think in the industry many people can match the packaging of financial data for reinsurers. And the depth of your team has some staffing and some professionals involved that really are worth knowing about. So people in our audience today right now might say, well, everybody packages the same. Don't they, Sylvie?
I mean, based on my experience and what I see on these particular cases when we are in competition, we do a phenomenal job and an exceptional job of gathering the information up front, being very strategic and very careful in terms of when we decide to send our financial package to the reinsurers. If we don't feel we've made a strong enough case, we wait, we work with the advisor to see what would be reasonable and available to obtain. And we really try to present the strongest case the first time. I think this is key to when you're trying to maximize the amount of capacity available out there. Yeah.
In a case like that, I just remember us finding that the reinsurance market had an appetite for about 60 million for a family like this, and you were able to push it closer to the $100 million target, to a $92 million plus some growth. And that was because you hesitated and drew in more financial evidence before you sent the package. Is that a good way to summarize it?
Yes, that's perfect. That's
Excellent.
exactly
Thanks,
right.
Sylvie.
Yeah, thanks, Drew. So next we can move on to the next slide. Okay, so this will kind of summarize what we did on the medical underwriting side, because the financial underwriting side was interesting, but the medical underwriting side had some challenges as well. Since we were lead carrier, we obtained all the evidence to underwrite the case medically. Upon receiving the requests from the other carriers, we shared our evidence within 24 to 48 hours. Evidence is never held back by Canada Life until we make our decision first. I have seen this from other direct carriers, so just know that when Canada Life is made the lead and we are directed to order the medical evidence, We do share it as soon as we receive those requests from other direct carriers, so that we're really looking out for the client's best interest and helping them get the planning that they need in place as quickly as possible. Medical underwriting on the male life was straightforward. We obtained insurance, medicals, labs and paramedical through Donacare, and an APS from the Canadian GP, so family doctor. Since the insured was new to Canada and had only been seeing a doctor here for 2 years, and because of the amount being placed on his life, we also obtained a copy of the insured's last physical overseas. The client himself was able to secure this and provide it for review. Evidence collection and review took a very short 13 days, including reinsurance approval, so that the male life was easy peasy. The female life was a little bit more challenging. We obtained the same evidence as her spouse, insurance, medicals, an APS from the GP, and a copy of her last physical overseas. The APS from the GP had a recent consult in which the insured complained of sleep disturbances and was referred for a sleep study. The doctor indicated the sleep study had not been completed to his knowledge. This was a problem since the symptoms were reported during the last doctor's visit over 8 months ago, and the symptoms had not yet been investigated, although the doctor had recommended for them to be. Canada Life worked with the advisor and was able to get confirmation from the client that she had not completed the sleep study since the symptoms completely resolved on their own. The client explained that during the first year of living in Canada, she would wake often at night and would have a headache most mornings. She confirmed that these symptoms completely resolved over 6 months ago and were felt to be caused by the change in environment with her new surroundings from moving. Given the insured was young, female, and had a small build, we felt that that explanation was reasonable, and our concerns over the client's chance of having obstructive sleep apnea was very small. We presented the case in that way to our reinsurers. Some of our partners initially wanted to offer with a rating to be reconsidered once a sleep study was confirmed normal. We engaged in several calls with our partners and were able to get some standard offers, and a smaller amount of the capacity ended up being rated. So once we blended the reinsurance offers with our internal Canada Life standard offer, we were able to issue the female standard after our rating reduction program called Astra. The part of this case study that makes me the proudest is that even with our sharing the evidence with our competitors, even with the added time it took us to negotiate favorable offers, we were still able to make offers for the full amount applied for weeks before our competitors completed their assessment for their internal amounts. This case was placed with us 2 months after the application was submitted. So that's another great example of all the hard work that the teams are doing in this market, particular segment.
Well, thanks, Sylvie. Good to be here. I hope everyone has had a good start to the year. A bit of background on my role: I lead our large case services team, our head office team here at Canada Life. It's a cross-functional team of actuaries, tax and financial underwriting professionals, which Sylvie just spoke about. Our Lifeline illustration team, all really here to support any and all large cases. My specific role, the last pillar here, was created last year, and my objective is to work closely with the asset management teams that run our par account assets, and then bring that insight and knowledge and understanding back to support our large case advisors, wholesalers, clients on anything that's par investment related. So if you're working on a large case and they ever have par investment related questions, they want to dig deeper, please feel free to reach out. If I don't have the answer, I will certainly work with the asset management teams to get that answer for you. Our team, our large case services team, is just one part on the next slide, Julie, of the broader head office support that is available. And we would be the top left-hand corner, the top 5 circles on the left-hand side. So From an investment perspective, we have various initiatives that we're working on with the goal really to provide insight and confidence into all the great things that are happening within our PAR account from an investment perspective. So we're just finishing up the latest version of Financial Facts, which is really the industry's gold standard for financial disclosure for PAR. Our most up-to-date version, our 2021 version, will be released a week tomorrow with our large insurance live event. So that should be out shortly. In an effort to continue to support conversations with large case clients for advisors, we've also started a new series called Investing with Conviction on the next slide, Julie, which is available. So this is a new series. The first kind of deep dive in this series, which was released last December, was a 6-page document highlighting all of the benefits that our PAR account has by utilizing and capitalizing on our unique ties to the Power Corp and the Power Corp umbrella, and how we can take advantage of access to some real industry-leading asset managers for our PAR account policy owners. The second report in that series, which we released in March, is a 9-page report, really highlighting some of the specific asset classes where Canada Life is very well positioned relative to other PAR accounts, and where we believe that this should lead to a sustained competitive advantage in the future. And then our third report, which isn't in this deck, which provides some good insight into the active management in the Canada Life PAR account within each and every asset class. That should be out in early May and should provide some real great visibility into each of these asset classes. So certainly been a very busy and exciting time for the Canada Life PAR account from an investment perspective. So I wanted to spend the rest of my time today really speaking about 2 key themes. And these themes I speak regularly with large case advisors and firms on, because what we find is that a lot of large case clients who are investing a lot of money like to understand this level of detail. They want to know how the PAR account is invested. They want to know what we're doing in there from an investment strategy perspective. So I'll provide a kind of a quick high-level overview of a couple topics. The first being, really our overarching PAR investment strategy. And then the second, as Drew mentioned, we announced some exciting changes last year. So spent a bit of time just providing a little bit of an update in terms of execution and how we've been investing over the past year for the PAR account. And like I said, this is the type of information that really seems to resonate with large case advisors and clients. So this first slide here, really quick high-level overview or recap of who actually manages the assets in our PAR account. As you can see here, there's 6 major asset classes along with policy, loans, and cash. On the fixed income side, so the right-hand side of this chart, it would include public bonds, so corporate bonds and government bonds, private placements, so private debt, and then mortgages. And all 3 of those asset classes would be managed by internally owned and very established and strong teams that have been around for a long time. On the non-fixed income side, so the left-hand side of this graph, so real estate, public equity, private equity, you'll see there that our assets are managed by a mixture of both internally owned teams, so GWO Realty Advisors, for instance, and then external asset managers as well, and some real industry-leading companies that we're fortunate to invest through for the PAR account. This next slide shows our PAR account asset mix as of the end of the year, and this detail will be in a Financial Facts document, which, as I mentioned, will be out later next week. If you take a look below the surface, there are really 4 key principles which really govern how the PAR account is managed in terms of investments. The first would be maintaining a long-term focus or a long-term lens. This is a long-term product, long-term commitments, long-term guarantees. Our teams are not willing to sacrifice long-term stability and performance, strictly reaching for short-term success. The second would be active management. Each and every one of these asset classes is actively managed by different teams of experienced managers that really do work every day, day in and day out, to try to maximize risk-adjusted returns for policy owners. The third would be diversification. You can see the asset classes that that we invest in on the sides here, but also just as importantly within each of those asset classes. And then lastly, and this is a key differentiator, really remaining steadfast in our focus on high quality assets throughout each of these asset classes. So very strong due diligence processes in place. So we are fortunate to be the largest open participating account in Canada, close to 50 billion in assets as of the end of the year. So a lot of strength and stability that provides, but also several other benefits from an investment perspective from being that large. As you can see on the slide here, we have the ability to develop infrastructure, ability to have teams, for instance, having boots on the ground, so teams on the ground in real estate, in commercial mortgages that know those local markets very well and can quickly act. We have the ability, given our size, to diversify across a larger group of assets. So if you think about illiquid asset classes like real estate, commercial mortgages, we can spread that exposure out across a much wider range of individual illiquid assets, which certainly can benefit the par account. Access to good or best-in-class external asset management partners. I already spoke about the ability to realize economies of scale. Being a lender of size, so we have the ability to lend in very large numbers and compete where there are potentially fewer competitors. For instance, in the commercial mortgage space, which could lead to improved spreads. So certainly some advantages in terms of being the largest in the industry. Moving to the second topic, very excited to kind of provide an update on the latest evolution in our asset mix or investment strategy, which was approved by the board early last year. If you'll recall, in early February last year, we did receive approval from the board to adjust the overall asset mix for our par account to have 30% of our invested assets in non-fixed income investments. So a 5% increase. Doesn't sound like a lot, but it's a shift of more than $2 billion. And therefore, the fixed income weighting falls to 70%, down from 75%. This is really just the latest in a series of different changes, both at this kind of high asset class level. And we are continually focused on evaluating how to best manage this account. As I mentioned, the teams are constantly active, and this will likely continue to evolve as we go forward. So as we talked about last year, we're increasing our non-fixed income weight, but also diversifying within the non-fixed income space. So you can see on here what we announced last year. So we announced that we would be growing our private equity exposure to 4%. We would be increasing our exposure to U.S. public equity, also moving it up to 4%. And then our real estate allocation will continue to grow, targeting 12% from 10%. And that includes growing in both Canada and the US, and growing through both acquisition and real estate development, also a key differentiator relative to other par accounts in Canada. So a big part of the reason as to why make this change now, was really to try to take advantage of our access to expanded and enhanced asset management teams and capabilities. As I mentioned, really trying to focus on taking advantage of our ties to the Power Corp. And this slide just shows which of the new firms that the par account has started to invest in, when we started to invest with these firms, and I can speak to some of these as we go through the deck further. As part of this latest shift, on the next slide, we are continuing to invest more in foreign assets throughout all the asset classes. Also a key differentiator relative to other par accounts, fully hedged to reduce any foreign exchange risk. And obviously by investing more outside of Canada, you're going to have exposure to a much wider range of companies, industries, different local markets to invest in, and we believe also potentially driving better returns going forward. So very excited about that continued growth. These changes will also continue to increase our exposure to alternative assets, important from a diversification risk and return standpoint. And as we mentioned last year, once we fully implemented these changes, we expect that our par account will offer industry-leading exposure to alternative assets relative to other par accounts. So also very excited about what that can mean for our par policy owners. So this slide is really a first glimpse as into execution. So last year we announced this. Very happy to be here to provide some insight into execution. And as you can see, the par accounts non-fixed income weighting grew from 21.9% at the end of 2020 to just over 30% at the end of last year. So successfully achieving that interim target mix, which we laid out early last year. As we continue to grow in the less liquid private equity and real estate asset classes, we expect to get to that future state over the next 12 to 24 months. So wanted to spend a few minutes just providing a little bit more insight. And this is the type of insight that we find really resonates with high net worth clients and advisors. What have you actually been investing in? What assets are you actually buying? And so I just wanted to spend a quick few minutes providing some insight into that. So this is real estate within the par account. The teams have done an exceptional job over the past year. You can see the different assets that they have been buying and building for the par account. So adding more than $500 million in physical direct real estate to the par account. So we now have 76 actual physical real estate holdings in the par account. You can see on the side in Canada, we added a couple of industrial properties in British Columbia, a large land parcel in Richmond Hill, which will be developed in the future. In the US, even more active, adding more than 300 million in industrial property, including a new New York City land parcel for the par account, which will also be penciled in for future development. A couple of actual assets that were purchased last year for the Canada Life par account, if we can move to the next slide. This first one is a recently acquired 178 unit multifamily residential property in Charlotte, North Carolina, called the Mint. Really exciting property, great location in uptown Charlotte, directly adjacent to Truist Field, their baseball stadium in Charlotte. Highly amenitized building, good walk score, and certainly some upside potential in terms of capturing higher market rent as tenants turn over. Another great example of an asset that the par account added last year. This is an industrial portfolio in Massachusetts that was acquired by the par account back in May for just under 100 million. This would be a Class A property, great location just outside of Boston, strong tenants in place, and really well connected to deliver on distribution needs. So really capitalizing on the continued growth in e-commerce. In public equities, our CIO, Brian Allison, and myself, we work closely with Mackenzie Investments and then Putnam Investments as the year went on to really conduct due diligence in terms of how we can position the par account to really capitalize on much broader public equity capabilities that Mackenzie and Putnam bring to the table relative to our internal asset manager that used to manage this money for the par account. So we did reallocate a good portion of our public equity investments at Mackenzie and Putnam. We broadened the style exposure for the par account, so value, growth, dividend, large cap, mid cap, and then continue to expand that Canada-US mix. And obviously exciting for us, certainly exciting to see the equity markets cooperate last year. Canadian and US public equity markets obviously had a very strong year last year, really leading the way globally for public equity markets. So very excited about the changes we made and also the performance in the market. And then lastly, just in private equity, which is really an emerging and exciting part of our PAR story. This private equity story has really resonated with a lot of high net worth advisors. We have been very busy investing in the private equity space in both Canada and the US, leveraging our ownership stake in Northleaf, accessing opportunities through Sagard, through those ties to the Power Corp. But we also acquired a stake in Sagard itself last year. And then really continuing to invest with some of the largest and most well-renowned US private equity firms south of the border. So in total, Canada Life PAR committed more than $500 million last year in the private equity space across 9 different private equity funds or mandates. So bringing our total commitments to more than $1.1 billion year total to date. And you can see on the slide here some of the different private equity strategies that the PAR account's investing in. So private equity, private credit, venture capital, and infrastructure would be the different types of funds that we have been investing in.
Ryan, it's Drew.
Yes. Hey, Drew.
Hey, listen, not many companies can actually say their PAR account management is this exciting. So I really want to thank you for your influence that you've had over the last 14 or 15 months on this in particular. And names like Northleaf Capital alone have got a number of key MGA partners actually moving a lot of business towards us. I've got 3 questions for you that have built up in the queue. One
Sure.
from my good friend Bob down east in the Maritimes saying, there's been a recent federal income tax or a new tax put on insurance companies from the federal government in the recent budget. Will that have any direct or indirect impact on dividends in PAR fund performance and attribution?
Yeah, that's a good question. That's really not my expertise. I would redirect that question to Graham. I know that question has come in over the past couple of weeks post that announcement. And Graham Rogers from my team has addressed that question. So if it's okay, Drew, I think we redirect that question to Graham. Like I mentioned, he has addressed that over the past couple of weeks.
Excellent. And I'll make sure to do that. And Bob, we'll find a way to get that out for you, but also for everyone else in the session. We'll find a way to make that more of a prominent answer so people understand if there's any indirect, when it's a tax on profits, it's really after the performance of the actual PAR account. So we'll get that answer out for you as a group. Another question we had was a number of companies have recently introduced PAR products. And the question is, are they confined to the same PAR account holding per asset class as Canada Life would be? So how would they compare in general, Ryan?
Sure. It's a good question. So for instance, RBC launched, I guess it would have been late 2020. They are 50% non-fixed income, 50% fixed income. So much more, risky, obviously potential for higher returns, but obviously quite a bit more volatility you would expect in a product like that. Manulife would be closer to 60-40. Empire, I believe, would be closer to 80-20. So there would be a broad kind of spectrum. At the end of the day, these are long-term commitments. These are long-term products. So, we're investing in a way, obviously it's still 70% fixed income. And I think Chuck will speak to our fixed income positioning. Really exciting how we're positioned with rising rates coming or here. But generally, they're still fixed income focused. But I don't believe that there's any restrictions in place, for instance. But obviously, if you're going all the way down the spectrum to 50-50, non-fixed income to fixed income, you're certainly taking on potentially quite a bit more volatility.
Ryan, I'll finish off with 2 very quick questions, easy answers, I'm sure, but a lot of talk about actual dividends. Dividends are actually accredited each year. And can you give us a sense of what we would have accredited last year for dividends to policyholders at Canada Life in terms of the amount given and where that might compare in the marketplace?
Sure. So I'm just trying to think. The 2021 version of Financial Facts will have that number. I believe we paid 1.2 billion in dividends last year, and I believe the messaging in there is that's more than every other par account combined. That was certainly the case in 2020. I believe that's still the case in 2021, but it was around 1.2 billion in dividends for 2021.
Right, and fantastic. And the last one is a very simple one, and that is, what part of this presentation or what pieces can be actually used by advisors in their actual presentations? Is the presentation itself going to be available or some form of it?
Yes, we can definitely help with that. That's a regular request, is to be able to show this level of detail. Those deep dive reports, which I mentioned up front, are also accessible and have really a lot of good information, this kind of insight, and we can definitely get that. So I'd say those deep dive reports, Financial Facts, and this presentation, we can definitely get available for everybody.
Good. We'll get those over to Don Hart. All
Okay.
right. I'll let you do the handoff then. Thanks so much, Ryan.
Yep. And I won't even speak to the last slide. The last slide is just an example of one private equity fund, but I want to be respectful of Chuck's last 10 minutes here. So I will pass it to Chuck.
So that was an excellent presentation that perfectly segues into the final piece, because having understood the investment strategy, the next stage usually is to progress to the time where you deliver the insurance to your client. So I know everyone wants to stand behind your recommendations. I know that the question always arises, what expectation should I set to protect my reputation, my practice, and the industry reputation? So what expectation should I set to protect the reputation of my practice and the industry reputation? And then the question is, what do I need to know when I'm actually doing competitive analysis? And is competitive analysis as simple as just picking the largest number on a series of pages? Well, it used to be that we used to always ask for more and more information, more disclosure, give me more, give me more. Today, information is so readily available that the new ask has changed from give me more information to just tell me what I need to know for analysis. Give me useful pointers and what I need to do to make a good recommendation for my client. Should I be using illustrations? If so, what illustration should I use? Is it the primary? Is it reduced? Or is it some other scale? Should I even be selecting based on illustrations alone? And I think that when we look at the Ryan's presentation, we need to understand where the money, where your premium is going and where it's invested and what returns we expect to get in the long term when we're making this decision. It's very, very important to understand that the numbers on the page aren't numbers that are promised. And then the second question or another question that people will ask is, will I get the best results if I simply use the illustration with the highest scale today? And intuitively, the answer is yes, but the answer is actually no. And I'll show you in this in my next series of slides why that's the case. And finally, what resources will Canada Life give me if I choose to work with Canada Life? I think that's a great question to ask. Okay, so let's start with what's the purpose of an illustration, how we talk about an illustration. And I want to get back to a very, very intuitive view of what the illustration is. So let's say, for example, we're talking to a client, and this is how I would typically present it to a client as well, is that if I wanted to propose a $100,000 deposit for 10 years, and we're going to assume a fixed rate of 5% for a 40-year duration, what are some of the points we have to hone in on? I mean, is it reasonable to have a conversation around a fixed rate 5%? Should it be 6? Should it be 4? Should we disclose to the client that those rates will jump around quite a bit over the 40-year duration? And should we ever really be telling that the illustration number there is the number that you should expect in 40 years? And I think that we can all agree that answer is a very hard no. And we need to translate this particular conversation when we're looking at illustrations, because it's a very, very similar idea. What we look at is, well, if we're projecting out 50 years plus, should we be setting an expectation to a client that a $6 million value is what they should be expecting at that point in time? So I think the answer, again, is a hard no. And can we find the right number in the series of illustrations that we have in front of us? Will it be the primary? Will it be the reduced, or some alternate scale? And I don't know if anyone would ever hazard to try to nail that number. It's very, very tough to do. I think if anything, you want to go conservative, so you over deliver rather than over promise. Now, the other thing that we'll look at when we get to illustrations, and the important point of looking at the numbers is actually trying to identify to the client that in a fixed positive rate environment, an insurance policy can have periods in its lifespan where the numbers go in the opposite direction. what we're looking at here is a 20-pay policy with a 15-year offset. So this is really, I think, how we need to use the illustrations, by setting the expectations of how the values will move over time, not literally what the values will be over time. So that's how I would start looking at the illustration and how we want to use it. But what expectations should we really set? So what I should generally do is, we see a lot in the industry is that people start with the illustrations and then they work backwards or forwards from there. What we really should be doing is start again right from the very beginning. And what I'm going to look at is exactly what Ryan's gone through, is what the money is doing when it's being invested. These are all large funds. And if you're looking at the primary carriers, they're all hiring the smartest people in the industry. They're all highly diversified over long durations where you're buying and holding. Most funds are generally fixed income, which are subject to change. And the dynamic asset mixes will change over time. So if we take a look at where Canada Life is and why we believe Canada Life is a better barometer for where we are in the investment environment today, is that because of our short bond ladder, we converge to where the economic environment is today, which I think sets better expectations to the clients, because we know in the long term, once you stretch out that timeline, the results will come in very similar. And by looking at this table, we see that is actually the case. And what I've done is I've picked 3 large companies with similar par funds using the dividend scale interest rate. You may ask, why didn't I include some of the smaller carriers? Well, smaller par funds have different characteristics. Why didn't I include Manulife, for example? They never really published their dividend scale interest rate until very recently. So it's just not useful for this comparison. So what this is, highlighted in that red box, is the average DSIR, or the dividend scale interest rate, from the 3 companies listed here going back to 1993. Now, looking at this table, it's very, very hard to tell the story. So what I'm going to do is I'm going to translate this into a series of charts so you can see what I'm trying to convey to you. So I'm going to go back to 1998. And the reason I picked that year is because that's when I started in the industry. And I'll explain to you what all these lines represent. So the dashed line represents a compounded value based on the average dividend scale interest rates of all of the three carriers there. The current illustrations in 1998 is represented by the DSR compounded by those lines. So if I was looking at the current illustrations back in 1998, clearly the product I would have sold is the green product. And now here's where there's reputational risk. If we look at our illustration and we don't believe it is the expectation we're setting for our clients, that we should caution to them that illustration is probably overstated in the long run. And if 1998, I had a crystal ball to see what would happen in the future, I would see that the green product would have been vastly, vastly overstated. And the client will come back to me to answer for why the numbers are so far off. So I'm going to cycle through the years just to kind of represent us going through the chart year over year to see how these values move. And one of the reasons I want to show you this progression of slides is that dividend scale interest rates don't change the same across different carriers by magnitude or frequency. So I'll show you what I mean by that. So in 1998 going to 1999, we're going to see one dividend scale interest rate move. It's not the highest one, it's the one in the middle. And then in 1999 to 2000, we'll see that one actually drops quite dramatically. And this one here, the green line didn't disappear. It actually went from up very high and superimposed over the yellow. And this happened over a matter of just 2 years. So now we see an increase, but then we see an increase. So they're actually going in opposite directions in the same economic environment. And this is due to a lot of variables. But now she would be selling on current illustrations. And I would argue that had I sold yellow at that time, my illustrations would have been pretty close if DSR was the only variable that we should be looking at. These other ones would have been overstated. So if we continue to fast forward, we'll see that the lines jump around. The pressure is in the system. So the par fund, they're invested into real assets. So they have to move according to where the economic environment is. There's no expectation. I don't think anyone should take that the numbers will maintain for the long run over a very long time. In 2008, and here's another thing about frequency, expectation, and magnitude of changes. We all know what happened in 2008, but there was no response in 2009 to the DSIRs. The pressures in the system, the par funds start to respond, and you'll see how they move in 2010 and going forward. So, and that's the pattern. So now we're here today, 2022. Well, if you looked at 2021 numbers, now we have a series of current illustrations. Which is the one that we want to convey to the client as the one that we should expect? Is it the one that we think is the closest to where the long-term economic environment will be, the one that's higher, Do we believe that they can maintain for the next 30, 40 years an advantage? Or do we think that no one's right and the hypothetical future number, which I'm just guessing, is some other number? And if that's the case, would it be probably a good strategy to set expectations where if we want to say, we believe this 5% is overstated, then why don't we show 4? And then there is another competitor in the same market for over long durations that's 200 basis points higher than what we expect the long-term average to be. Do we reduce them by the same 100 basis points, or do we reduce them by 200 basis points? So I don't know if anyone wants to really play that game of nailing where we think the illustrations will go, but I think that when we look at the history and the behavior and how the dividend scale interest rates move around, it's important to understand that this is really real money going to real things. And if we want to set expectations, we need to be realistic. And simply picking the highest number on an illustration or the lowest number to exclude a particular carrier probably isn't a great idea. So that's just kind of maybe taking a perspective on illustrations I think is important. But I think the next stage is really talk about the dividend scale and the dividend scale interest rate, which the DSIR has become the dividend scale. And I want to convey how important it is to understand that that's not the case. One of the reasons I think the DSIR has become the dividend scale is because there are other changes to the other components are so infrequent and that we don't actually explain what they do to the product that we simply ignore it. And what I want to do is I want to convey that this is the question. I want to answer the question of, do we just pick the highest dividend scale interest rate for the illustration we want to propose? And I think the answer to this is no, probably no, because the investment factors in the early years is actually very, very low. And it doesn't actually start kicking in for about 5, 6, 7, 8 years. So if we pick the highest dividend scale interest rate today, that's not going to necessarily translate into the highest values later. We basically have to look forward to see where we think the investment strategies are going so that we can pick the best option. And that's why it's important to understand the strategy that Ryan just covered. So really quickly, if we look at the insurance values, it's actually pretty intuitive. If you go back to where the money's gone, it's going into real investments. And those real investments over time, if everyone died way out 50 years later, then it would just be based on investment returns. We know that's not the case. We know that people die in the early years, and what the par fund has to manage, it has to make the money available to pay out to people who die early by the red line by giving you cash values below what the cumulative premium is. So there's several hundred chunks of these that will be available that we have to plan for to pay out to people that die prematurely. So I hope that looks a little more intuitive. And if you think about all the different things that can affect what happens there, I think that helps you understand where that goes. I know I'm running out of time here, so I want to quickly show you what happens in the dividend scale when I say current or -1. Here is the -1 scenario versus the current scenario. And it happens and it changes in a day. So if one day the current dividend scale is this and it goes by 100 basis points, it'll go down in this way. And if I peg this for reference, you'll see 100 basis points changes the long-term number, but it does very little to the short-term number. See that? It's very, very little. So basically, why do I want to show you this? And why did I show you the chart before about where the dividend scale interest rate kicks in? Is that we see that the companies are trying to tell you where we think our dividend scale interest rates are going, so that once the DSR starts to kick in, you can see where the illustrations will be the most meaningful. And this is a version from Canada Life. It's words, we don't have a chart, but basically says, under certain assumptions, here's where we see our investment returns to look like. And here's something that very few people have actually seen. This is a current dividend scale where the alternative changes only mortality. And what you'll see, if a 1% improvement in mortality, there is a material impact in the numbers. So reduced scales and illustrations in the industry only change at DSIR. None of them that I'm aware of change anything other than that. So if we see that there's mortality, and depending on how the insurance company plans their other assumptions, it can materially affect the numbers. In any case, I think I'm out of time here, so I just want to quickly wrap up and say what happens if you choose Canada Life as your partner. What I've added here is a regional sales manager or a wholesaler. For the GTA region is David Kerman, and working behind David and every other regional sales manager across Canada with Canada Life, there is a team, a large case team, which consists of advanced case consultants and tax planning experts that will join you to point of sale, virtual or in-person support if you need it. And for case consultation as well, they can produce custom pieces and in-depth work. So with that, I know I'm a little bit over time. I want to wrap, and if there's any questions that anyone wants to ask, I think we can see them in the chat.